Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day. Today's stock is Cleveland Cliffs. We'll discuss, should we pass or should we play? Hello, my name is Brian Overby. I am the Senior Options Analyst with Ally Invest.
And I'm Lindsey Bell, Chief Investment Strategist with Ally Invest.
All right, Lindsey. Well, we've talked a lot about the chart in the S&P 500 index. We've got a little bit of chop, a little bit of bounce back. There's just a lot of noise in the chart. What do you see going on in the markets this week?
Well, this week, Brian, I think we're trading a little bit choppy, especially today. And yesterday, too, we saw some of that. And I think that's the market really preparing for earnings season, which kicks off in earnest tomorrow with a bunch of the banks that are going to report earnings through the end of the week. So everybody wants to know, it seems like second quarter earnings growth was the peak at 89%. Okay, that's a pretty big number. And so, of course, we're going to moderate from there. What we're looking forward to in this third quarter is about 24% earnings growth from here. But if we look, I'm going to get into that in just a second. I just want to take a look at that chart since you brought it up. The S&P 500 here, it has been choppy is the best way to put it. I think that we had that big pullback on the rise of interest rates on the back of the Fed speak and quantitative easing coming on and tapering happening. So things like that, as well as some of the debates that we saw out of DC, including the debt ceiling, which, by the way, I know you're going to get into, that was a crisis that was averted for now. We're kicking the can down the road, right? But all in all, this week, it's going to be all about earnings. This morning, we got small business optimism came out and it held pretty good. It ticked down 1 point. The uncertainty index within that ticked up. People saying that they're not, a lot of small businesses are not able to find employees to fill the jobs. They're talking about raising rates and how the supply issues are impacting them. And that is a lot of the same storylines that we're going to hear throughout earnings season this quarter. Like I said, earnings growth in the third quarter is slated at 24%. If we look out to the fourth quarter, everybody's going to want to know what management teams are thinking, where growth is going in the quarter ahead and in the year ahead. In the quarter ahead, we're looking for 20% earnings growth. So a little bit of a deceleration that certainly can come down as the earnings season progresses. But on investors' minds are going to be how the supply chain disruption is impacting profitability and operating margins at corporations. How is inflation impacting and where do we see it going? Is it going to be transitory? How long is it here to stay? That is what is weighing on top of mind for investors. And so I think we're going to look for it in those margin lines. We're going to look for it in earnings growth, and we're going to look at top line growth too, which, by the way, is supposed to come in at about 11.5% in the third quarter, which is a pretty strong number. We'll see how that's impacted by the companies that are able to pass all of these higher costs related to supply chain disruptions, inflation, labor shortages, et cetera, how those companies are able to pass it through to the consumer by and through higher prices. If they're able to do that, maintain margins at the very least, I think Wall Street's going to be happy, but this isn't a one size fits all issue. It's going to be the companies that can do that are going to benefit. You're going to see the performance in their stocks move higher, whereas the ones that can't and up against issues where they're not able to pass cost and price increases on, they're probably going to get hurt a little bit more. So it's going to be a difficult and interesting earnings season because, Brian, in 4 of the last 5 earnings periods, we saw estimates move up going into the reporting period. This time, we're seeing them move lower, which is good. That gives companies a lower bar to work with from a beating perspective. And the other good thing for the market is that it's down 3.6% in the past month and a half heading into earnings season. So that bodes well, again, setting the bar lower for companies from a performance perspective. But those issues that I just talked about are going to weigh heavy on individual securities. So I think this is really going to be one of those earnings seasons that is for the stock pickers. If you get it right, you get the companies that are higher quality and able to manage and navigate the situation better, those are the stocks that are likely going to perform better. So that's what I'm keeping my eye on. But Brian, that's just one aspect of what's happening in the market. The other thing that happened this morning was the IMF downgraded their outlook for growth for the year ahead. And that was really driven by the developed markets. They took it down from 5.9% to 5.2% for 2021 growth and in GDP terms. And so that is one negative, but the market seems to be absorbing that pretty well. Of course, it was related again to inflation and supply chain issues. So those are the key topics that are going to drive, I think, the market in the coming weeks. But as we get closer to the end of November, Brian, those government DC issues are going to pop back up. And of course, we never know when the spending bill issues are going to crop up, pass or not pass, or be debated and negotiated as things go on. How do you see that being priced into the market right now?
All right. Well, the way that I like to talk about it the most is to actually just look at the Vix Index. And so I have our Vix watch list up, which we usually look at on the stock play of the day. And we see the VIX actually did come down below the 20 level. So it's trading at 1908. And if you look over here on the chart, the line in the sand is really, I've never seen more of an established line in the sand in the VIX than we have over the past year and a half, ever since the downturn in the pandemic and the big crossover of that 20% level. So it's always interesting to see, are we above that level or are we below that level? The marketplace seems to define high volatility as above that 20% level and lower volatility as below it. And you can translate that into investor anxiety. Now, on last week's show, when we had the VIX up over the 20% level and it was hanging right around 22, 23% and not really giving up a lot on the downside, even on up days, it struggled to break back down below that level. Well, it turns out that all of a sudden the government came out and said, okay, as you mentioned, we're going to kick the can down the road on the debt ceiling discussion. We're going to come up with a bill that's going to give us a short-term solution on it. And then we finally seen the VIX come off. So that anxiety, you don't always know 100% what causes the VIX to be where it's at, right? It's trying to predict like what the weather's going to be a couple of weeks out. You have no idea based off of what's really going on today. But with that being said, that seems to have taken off some of the anxiety in the marketplace, and hence we see the VIX now down below that 20% level. And we've been trading right around it. So if I zoom in a little bit on this is the actual VIX chart. We see we came down, we got down to right around that 18% level, but now we're back up, spiked up a little bit. Now we're trading right around that 19% level. So that anxiety is not totally relieved, which makes sense because they, once again, just kicked the can down the road. But if I go out to the futures contracts that track the options that expire in January and December, we still see it around 22% in December, 23% in January, up over the 20% level in November. So that anxiety is still there. It has waned a little bit, but it is still there. All right. So a lot going on in the markets, a lot's going on with the underlying stock. We're seeing the dollar kind of doing a little something odd. And as I think you said before, what does the dollar know that we don't? And because of that, we're kind of looking at some material stocks today. Cleveland Cliffs is the one that we're going to get into. And here is the chart on Cleveland Cliffs. I want to bring that back to you before I want to look at the chart just a little bit, because some interesting things have happened in the chart on Cleveland Cliffs recently. I have a Fibonacci numbers drawn on here from the downturn. That was right around 3107 all the way down to, where is this area, 18, right about 19% level. If we look at the Fibonacci numbers, we actually filled the gap. So we had a big downturn here on the 17th of September. We came back and we just are filling that gap today. So that makes it interesting. If you look at the Fibonacci's, obviously the 50-day, there's going to be a lot of resistance right in this little area here, because the red line is the 50-day moving average, and that's also the 50% retracement level. that would be a good sign for a marketplace. I would look at that overall. And also we have earnings coming up on Cleveland Cliffs. I will talk a little bit about that on the 22nd. They'll be having earnings. Maybe that could push us through this level. As Lindsey mentioned, we are in earnings season. But this is a real interesting area to me, right around that 50% retracement level, right where this 50-day moving average is at. And once again, if I just go back and highlight this, we did have that death cross where the 20-day crossed over the 50-day, and that's where we actually saw a fairly big downturn in the marketplace overall. But I don't put a lot of weight on that. The 200-day did its job right down at the bottom of the chart. It held its own, came down and touched it a couple of times. And so the weakness wasn't there. The 200-day was able to hold, and the chart is interesting overall. What do you see in Cleveland Cliffs?
All right, Brian, that is great analysis and look at the chart. It's always good. You know, I'm a fundamentalist, so I'm looking at the story behind the stock. But I always do enjoy looking at the chart because you can learn so much just by looking at the chart and listening to what Brian just told you about it. Before I get into my little spiel behind the stock, I want to remind everyone that there is a chat box on the right-hand side there. Brian and I are going to be taking your questions at the end of the show. So feel free to type in there anything that's on your mind. We'll take as many questions as we can. We'll definitely leave a few minutes left for that. And in the meantime, give me a wave to let me know you're there, you're awake, we're not boring you. We love to see your faces here. So thank you for being with us. So back to Cleveland Cliffs. You know, Brian and I, we wanted to look at the materials sector in general because it's a sector that hasn't performed so great lately. It had a hard time in the summer, but it seems to be kind of hanging in there over the last, several weeks, despite the weakness that you had seen in the S&P 500. And I think when you think about the materials sector, we've seen investors rotate in and out of this sector all year long, or actually since really the beginning of the pandemic, as the reopening story was debated and pushed and pulled back and forth. We're kind of entering that phase now as we see the Delta variant begin to die down. We see more and more people getting vaccinated. And we feel like, knock on wood, that we may be getting closer to seeing brighter days in this health crisis. And if that is the case, then you see the reopening plays should begin to come to life. The materials sector, industrial sector as well, hasn't really done that quite yet. And the reason why we're taking a deeper look at the materials sector is because this is in particular a sector that would benefit from any uptick or stimulus that might come out of the emerging markets or China, as they are more likely to begin to see growth improve than we are here in the developed markets. You actually saw that in the IMF's outlook. They talked about, I mentioned they brought down the developed economies growth outlook, but they raised it for the emerging markets, including places like China. So that is certainly something that bode well for the material sector. If we get any infrastructure spending bills through Congress here in the U.S., that'll benefit the group, and likely we're most likely to get something through. It might not be $3.5 trillion, Brian, but I think the government does want to do something to continue to stimulate the economy. So that would bode well. And then, of course, you mentioned the dollar. The strength in the dollar isn't the greatest thing for the materials sector, but it's interesting to see the dollar strength with higher oil prices and higher commodity costs in general. It'll be interesting to see how that plays out over time. But to the extent, given the move in the dollar, I think it's possible the dollar could pause here, maybe even potentially soften. That would bode well, again, for the material sector. So we were debating which stock should we look at today. We looked at a bunch of different charts, dug through a couple different stories. I think one thing that popped out for me with all of these stocks that we looked at, we looked at, Cleveland Cliffs is a steel company, but we looked at some of the chemical companies like a DuPont. We looked at the container and packaging companies. And what really caught my eye is that a lot of these stocks seem to have bottomed at the end of September and moved higher. So if I look at just the material sector in general, since September 1st, it's down 4.6%. But over that same period, we've also seen oil prices rise. Oil prices are up. What I wrote it down, 15%. Steel prices are up 36% since the beginning of September, and these stocks just haven't followed suit. So to me, when the commodity is rising and these guys are suppliers of that commodity in a way, shape, or form to their customers, that could be a good thing for them as they're able to charge higher prices, get better margins, things like that. This stock, Cleveland Cliffs in general, is popping today. Brian pointed out that we were closing that gap. It's on the back of acquisition news. They announced yesterday that they're acquiring Ferrous Processing for $775 million. It's a scrap metal business. So they're expanding into that business. And so obviously investors are really liking that. When I look at this on from a valuation perspective, when I look at the historical price to earnings on this, it's a little bit of a tricky company to look at because, you remember the whole trade war steel debate with Trump. You saw the valuations of a lot of these companies expand on the back of that. They've since come in. It's trading at just under 3 times. Even pre-2019, this is a stock that traded at least in the 5 to 6 times range. So the valuation still looks good. We remain well off of its more recent highs. You look at that chart there. And even though it's up about 11% off of the 200-day moving average, we haven't reached a 50-day moving average. It seems like there could be room to run in this stock, but I think you can also look at different material stocks in general. If you are a believer of the reopening story, you're a believer of the moderating dollar, you're a believer of infrastructure stimulus money coming our way and China really supporting their economy from a hard landing, I think, it might be time for another rotation into this sector. That's what I'm thinking, Brian. But how can you play it? I love the idea of playing this with options. I mean, you mentioned earnings season is coming up. And so having a shorter term time horizon might bode well here. But I don't know what you're thinking from an options perspective.
Yes, and we can. And like you mentioned, now there are some ETFs that track the sector. The XLB and the XME. Did I get those two right? Yep. Okay.
Yes.
So if you were just thinking about the sector, as Lindsey was mentioning, those are 2 ETFs that focus on materials overall. Now, with Cleveland Cliffs, we have earnings. So whenever you're talking about options around earnings, it's going to affect your strategy without a doubt. So let me go and look at the Cleveland Cliff option chain. And today we see that we're up about 2%. So it's a $21 stock or $22 stock. So a smaller move is a higher percentage overall in that underlying. We see here in the Ally Invest option change that we're highlighting, the earnings date is on the 22nd. So it's going to be here in the near future. And we're going to go out further in time. So I'm going to look at a long call, which here's the strategy inside the options playbook. And because we have earnings, I'm going to actually go a little bit out of the money. And if we are buying options around earnings, I want to err on the side of having more time as opposed to less time. A lot of times, if I'm looking at earnings and I'm trying to buy an option contract, I might go deeper in the money to get more intrinsic value. But now we want to use options to manage our risk. And I always say this on the stock play of the day, any option strategy that we're looking at, they're not meant to be recommendations. We talk more about the conditions of the marketplace. In other words, how the pricing is going on with this underlying overall to try to help pick a strategy. Because bottom line is, when you're looking at options, there's no golden book of rule as to what strategy you should do each and every time. It's all based off of the price of the underlying, what's going on with volatility, where's the overall marketplace at. So if I look at our chains, I'm going to go all the way out till next year. I'm going to go out to January. I'm hoping that any issues with the debt ceiling and all that would be taken care of by that time. But more importantly, we want to look at what's going on around the earnings. So I'm going to highlight, and I always like to check this in the options marketplace. I left the October 15th expiration up. and we have an IV column. I'm going to highlight the calls, and we have the implied volatility column. So if I just look at the most at the money option, the 22, we see that's trading at about a 58% implied volatility. It's nothing to sneeze at, right? That's a little bit of vol, which we would expect that in this industry is the word that I want. And if we go in and look at the next month out, the October 22nd, we see it's trading at 65% implied volatility. So that's showing you that there's something that's going to happen between these two time periods. And so the marketplace agrees with that earnings date. And then if I look at the 22 strike and I say, let's just buy the long straddle. In other words, we would go in here and we'd say, let's buy the call and let's buy the put. That gives us an outlook as to, well, what's the marketplace thinking that could happen after earnings? And right now that's trading for right around $2. So we're looking at about a 9% move. The marketplace thinks that that is feasible. Okay, so that's a feasible move after earnings. We're going to have a little bit of risk in this underlying stock because implied volatility is saying that. So here's what I'm going to do. We're going to go out to the January expiration, 101 days out. I'm going to highlight that in our option chain. And we're just going to go a couple of points out of the money because the marketplace says that that's a feasible move in the short term. This is more of a longer term play, but we're going to manage our risk by doing this. So we're positioning ourselves in Cleveland Cliffs to have some success if the forecast or if the earnings report is good or well received by the marketplace, but we are going to be limiting our risk. So the concept would be that if you were going to buy 100 shares of Cleveland Cliff at $22, you're talking about $2,200. We're going to take about 10% of that and we're going to buy that 24 strike call and we're going to spend $2 on it or $200, get us through earnings and then make a decision after that. But I want to take a small position. If I was going to buy 100 shares, I'm just looking to buy one call option. I'm not trying to leverage this situation. I'm trying to use options as what they were actually first intended to actually manage our risk as we go through the earnings season to see what might happen on after that fact. And if we do get that move to the upside, we do get that breakout back to the 50% retracement level and above the 50-day moving average, well, overall, that's a good sign for the marketplace. You could stay in your option or you could go and look at an underlying stock. So our official paper trade for the week is going to be by the 24 strike, January 21st expiration, 101-day call option. And I'm going to put that in the right rail. That makes it the official paper trade for this week. And right now we're at a 195 midpoint. So this market is okay in Cleveland Cliffs. A lot of the material stocks have a little bit wider bid-ask spreads, but this stock has enough volume in it that it's supporting a lot of that option trading overall. So our market right now is 192 by 198. If I'm just buying an option contract, and once again, we're just doing this on paper, I would look to pay somewhere close to the actual asking price. On just an individual option contract, it's kind of hard to fill at the midpoint. The midpoint is more so I focus on when we're talking about spread trading, like a long call spread or a short call spread. Those type of trades, I look a little bit more at the midpoint of it. But we'll call this, we'll say 197. How about that? Try to get a penny out of them. And that would be $197 plus commission. That would be our maximum risk on the trade. We'd have limited and known downside if after earnings the stock went down. And here's what it looks like in the profit and loss graph. I'm hoping. Come on up. All right, not quite sure why I am not getting a profit and loss graph to come up. All right, well, so with that said, if we look at the long call in the options playbook, we're seeing that we have limited and known downside and we have unlimited upside on this position. And we're going to have some susceptibility to implied volatility if the marketplace is, if after that earnings report, if the market doesn't move as expected, doesn't make that 9% move, you're going to want to trade out of the position fairly quick. But if we're putting this trade on, our outlook is, well, we're basically going to risk it all, right? Because we're limiting our risk to that 2 points that we paid for it. So my ideal, if I'm looking at this, my idea is that we're going to risk that $2. If we lose the $2, it's okay. If not, if the market does well in this position, well, at least we had a position on and we didn't miss out on the upside of a good earnings report overall. All right. So, Lindsey, do we have any questions in the chat box? And I want to say, please put them in the chat box. We're here to answer any and all questions if we can. If you just want to throw them into the chat box.
And we always do our best. We've got a couple of comments in the chat box, a few people smiling, saying hi, which is great. I'm going to start with Raman. Brian, would you sell near term a call to reduce the cost? If yes, what strike price would you choose?
All right. Now, I wouldn't sell a near-term call in this situation. I might have done that a couple of weeks back and had that near-term call expire before the earnings. Okay. And here's the pricing dynamic. When you're dealing with what are called horizontal trades, where you're buying a further out option and selling a shorter term option against it. If those option contracts get in the money on the short term, they move very quickly against your position overall. So around earnings, I wouldn't want to sell that expiration that contains the earnings. So if I were to do it, which I just don't know if there's going to be enough premium, is I would sell that very short term. So let me go in and look at the option chains again. We do have those up. So the 3-day option contract, you know, the 23 strike is trading for 14 cents on the call option. Just not enough premium. It's not worth doing. And I don't want to go and sell this one that expires after earnings. That 23 strike is selling for 55 cents. So if I were to sell an option overall, and today we're trying to just manage our risk by buying a little bit out of the money option, I'd probably stay in the same expiration. I'd stay in the January expiration, let me add a strike, and I would sell a couple points higher. That would be 4 points or so higher. Let's see. So the 25 is trading for 167. Let me see if I can get to the, we'll add a couple of strikes there. So we got the 26. So I'd maybe do a 2-point wide spread and bring in $1.44. You got 50 cents on the trade. You can do that. You can do that if you wanted to, but that's not really what we're looking at here. In that we have a lower price stock. $2 isn't a ton to have to spend to basically rent the stock over the earnings, right? So if I was doing this on a $100 stock, I would consider a spread. I would think about a spread a lot more than on a $22 stock. And that's mainly because the price of the underlying will affect the overall cost. And I would need that cost savings on the spread. So in this instance, we're comparing this to buying 100 shares of stock. We're going to actually buy this call option, go through earnings, and almost a fear of missing out, you could say. I want to participate in the earnings. I'm hoping that they will be good. And this is one way I can do it and limit my risk. But thank you for that question. Appreciate it.
All right. We did hear from Jason, who pointed out the P&L graph and probability calculator aren't working today. So thank you for that heads up. We'll be sure to look into it.
Oh, really?
Got our pal Wayne here with us again today. He calls you Professor Brian. He wanted to know if you could give a quick explanation of what exactly put call skew is. How do we figure it out and when to use it before our trades? But Brian, you only have 2 minutes. So
okay. All right, volatility skew. Basically, what it is, and we usually focus on the most at-the-money option contract, just so that you're comparing an implied volatility of a similar option contract overall. So with 3 days remaining, we see that this implied volatility, and I'm highlighting it here on my chart right now, is at 59%. If we go out to the expiration that contains earnings, we see it's at 66%. So that means that the marketplace knows that there's going to be an event that happens. And the most common time you'll see a difference, a big difference in implied volatility is when there's a known event, and the biggest known event is always earnings. So the marketplace is confirming that, yeah, something's going to happen between this expiration and that expiration. All right. And then based off of that implied volatility, and I'll just do it real quick, like is you just look at what a long straddle would be. And that just tells you that if you were to go out and buy that, and let me get rid of this January call, we're looking at about a $2 move. And it's that simple. A lot of people will say, well, how do you hear a lot of people get quoted saying somebody's announcing earnings and the stock's expected to move 9%, as we're talking about in this instance. It's not necessarily, this is just kind of the line in the sand. The marketplace is saying that a 9% move is feasible. Doesn't say it's going to go up, doesn't say it's going to go down. They're just saying that that's a feasible move after earnings based off of the price of the option contracts. Very straightforward overall.
All right, Brian, that's all we have time for. So we're going to have to call it a day there, but don't forget to check in with Brian on Friday right here on the Ally YouTube channel, where he will check in on this suggested options trade and the stock play the day overtime. I'm all tongue tied here. And so that'll be Friday. Be sure to tune in, right, Brian?
Yes. So make sure you click subscribe and ring the bell, and we'll see you this Friday. And then we'll be back next Tuesday for the next stock play of the day. Thanks for coming, everyone.